Hey everyone, and welcome back to Talk Tickers. Today, we're going to take a deep dive into Camden Property Trust's Q4 2024 earnings call.
Yep, we're going to break down the results, analyze their strategy, and try to extract some insights that you can use, whether you're, a seasoned REIT investor or just starting out.
Sounds good. So first things first, how'd they actually do in 2024?
Well, overall, pretty well. They exceeded their own operational budgets, which is, always impressive,
Yes.
especially considering, the multifamily market faced some headwinds.
Yeah, like all that record high supply of new apartments we kept hearing about.
Exactly. So exceeding budgets in that environment, I think it points to, Camden's operational strength.
Right.
And their strategic focus on those high-growth Sunbelt markets.
So occupancy and rents are holding up well in those Sunbelt areas.
It appears so. A lot of their key markets seem to have bottomed out, which suggests a potential rebound in 2025. In fact, Camden is projecting revenue growth between 0 and 2.5% across their markets for this year.
Okay, that's a pretty decent outlook considering, the overall economic uncertainty.
Yeah.
But here's where it gets interesting.
Yeah.
I think Camden isn't just sitting back and waiting for the market to turn around. They're actively shifting gears with a strategy they're calling, "It's time to move on."
Yes, this definitely caught my eye too. They're taking a page from their post-financial crisis playbook, which involved acquiring younger properties and selling older ones.
So they're seeing a similar opportunity now. Why is that?
Well, they're anticipating less new supply coming online, which could shift, market dynamics in their favor. It's like they're sensing a turning point and positioning themselves to capitalize on it.
What I find fascinating is that this strategy isn't just about buy low, sell high. It also kind of reflects a deeper understanding of the evolving preferences of renters these days.
Absolutely. Newer properties often come with, the amenities and features that today's renters are looking for.
Right.
Think modern kitchens, upgraded bathrooms, smart home technology, you name it.
For sure. And by focusing on these newer assets, Camden can attract and retain residents, even in a competitive market.
Right. And that can translate into, higher occupancy rates, stronger rent growth.
Makes sense.
And ultimately better financial performance for Camden.
This all makes sense, in the context of Camden's focus on Sunbelt markets. I mean, we all know about the population growth in Texas and Florida, but to put it in perspective, those two states alone accounted for almost a third of the nation's population growth in 2024.
It's a staggering statistic, and it underscores the powerful tailwinds supporting the multifamily market in those regions. Strong demand, coupled with easing supply pressures, paints a potentially bright future for well-positioned companies like Camden.
But it's not just about location and market trends, is it? Camden also emphasized the importance of their company culture and customer-centric approach.
That's a crucial point. They directly link employee satisfaction and resident retention to their bottom line. Happy employees lead to happy residents, which ultimately leads to better financial performance.
Yeah, for sure. Okay, so we've got a company that's exceeding expectations, shifting its strategy, and benefiting from strong market fundamentals. Now let's dive into some of the specifics of their portfolio.
Sounds good. One of the things that stood out to me in the earnings call was Camden's detailed breakdown of their markets.
Yeah.
Which they rank using this unique report card system.
Yeah, their market grades.
Yeah.
Ranging from A to C, it offers a really nuanced look, I think, at the varying dynamics within the multifamily market.
Exactly. For example, Tampa earned an A with an improving outlook, while Nashville and Austin are lagging behind with Cs.
Wow.
Facing continued challenges from new supply.
So even within the Sunbelt, there are clear winners and losers. Investors need to be selective and understand the unique characteristics of each market.
Couldn't agree more. A blanket approach to Sunbelt investing is unlikely to yield optimal results. Camden's market grades provide a valuable roadmap for discerning investors.
Now let's talk about how Camden is actively navigating this evolving market landscape. They mentioned being active in the transaction market in 2025, which makes sense given their it's time to move on strategy.
Yes, they're planning to sell older properties and acquire newer ones, even if those acquisitions are still in the lease-up phase.
So they're comfortable taking on a bit more risk to acquire properties that align with their long-term vision.
Exactly. They're essentially betting that those newer properties will generate higher returns over time, justifying the upfront investment.
And it's not just about acquisitions. They're also investing in renovating existing properties, particularly kitchens and bathrooms, to compete with newer developments. They even highlighted achieving 8–10% returns on this strategy.
It's a smart tactical move. Refreshing older assets can be a highly effective way to stay competitive in a market that's constantly evolving.
Okay, we've covered a lot of ground here. Camden is exceeding expectations, strategically shifting their portfolio, and benefiting from those strong Sunbelt market dynamics.
It's clear they're not just riding the wave. They're actively shaping their course for long-term success.
Now it's time for our favorite segment.
Yes.
This is not financial advice, where we take inspiration from the earnings call and cook up a bold but plausible trade idea.
Remember, this is purely hypothetical and for entertainment purposes only.
All right, so here's our outrageous but plausible trade based on Camden's bullish outlook and strategic moves.
Yeah.
Short, a broad REIT ETF that includes a lot of office or retail exposure, and go long on a Sunbelt-focused multifamily REIT ETF.
The bet here is that as the multifamily market recovers in the Sunbelt, it will outperform other struggling sectors within the broader REIT market.
Exactly. So you're essentially betting on the relative strength of Sunbelt multifamily and the weakness of other REIT sectors. Risky, but potentially rewarding if Camden's thesis plays out.
Again, this is not financial advice. Do your own research, consider your risk tolerance, and consult a professional before making any investment decisions.
All right. That's it for part one of our deep dive into Camden Property Trust's Q4 2024 earnings call. Join us for part two, where we'll unpack Camden's market grades in more detail, exploring the specific dynamics driving their outlook for each region.
Welcome back to Talk Tickers. Before we went to our This Is Not Financial Advice segment, we were about to break down Camden's market grades. Their fascinating system for ranking their markets based on anticipated performance.
Yes, I'm really curious to hear more about this, report card approach. It seems like a great way to understand not just which markets are hot, but the underlying factors driving those trends.
Exactly. It's all about context and nuance, which is what we strive for here at Talk Tickers. So let's start with the A-listers.
Okay, sounds good. Which markets earn top marks?
Well, we have a few standout performers. Tampa, Southern California. That includes both the LA Orange County and San Diego Inland Empire regions, and Washington, D.C. all earned impressive A grades.
Wow, those are some pretty diverse markets. What's driving their optimism in those regions?
It really varies. Tampa, for instance, is benefiting from strong occupancy, manageable supply, and a recent surge in demand fueled in part by hurricane-related activity.
Oh, so some of that demand might be temporary, right? Once things settle down after the hurricane.
Yeah, that's a valid point. It's likely to moderate over time. But even without the hurricane boost, Tampa's fundamentals look solid. They've got a good handle on supply, and the job market there remains strong.
Makes sense. Now, what about Southern California? Those markets have been on a roll lately, haven't they?
They certainly have. Both the LA Orange County and San Diego Inland Empire markets are expected to finish strong again in 2025. They've effectively managed supply, and they've also worked through a lot of the COVID-related issues that were weighing them down previously.
You're referring to things like, the bad debt and eviction moratoriums, right?
Exactly. Those factors are no longer major drags, allowing for healthier rent growth and occupancy in those markets.
Okay, so Southern California is looking good. And what about Washington, D.C.? It seems like a consistently solid, if not always spectacular market.
Yeah, that's a fair assessment. D.C. benefits from a stable economy and limited new supply, especially in Camden's core submarkets in Northern Virginia and Maryland.
So maybe not quite as hot as Tampa or Southern California, but still a dependable A performer.
Precisely. Now let's shift our focus to the B-grade markets, starting with Houston. They snagged a solid B+ with a stable outlook.
I'm curious about Houston. What's driving their performance?
Well, they've got limited supply coming online, which is always good news for landlords. And demand remains healthy, thanks in part to a robust energy sector.
Interesting how Houston has bounced back after those tough years when oil prices plummeted.
Yeah, it's a reminder that markets can shift quickly, and sometimes the best opportunities are found in places that have been overlooked or underestimated.
For sure. Okay, so Houston is a B+. What about the other B markets? It looks like we've got Denver, Atlanta, Phoenix, Raleigh, Orlando, Southeast Florida, Dallas, and Charlotte. Quite a mix.
Indeed. What's interesting is that Camden is projecting revenue growth between 0 and 1% for all 8 of those markets. They're generally seeing some easing of supply pressures, but not enough to really drive significant rent increases.
So it's kind of a mixed bag in the B category, with some markets showing more promise than others. Let's delve into a few of those.
Good idea. Denver, for instance, earned a B+ with a moderating outlook. They've got decent job growth and manageable supply, but they're not expecting the same level of outperformance they saw in 2024.
Okay. And then there's Atlanta. They have a B grade and an improving outlook. What's the story there?
Well, they've made progress in reducing bad debt and fraudulent activity, which were dragging down their performance in the past.
Wait, fraudulent activity? What does that even entail in the context of apartment rentals?
Yeah, it's a growing problem in the industry, unfortunately. It can involve things like identity theft, fake applications, and even organized schemes to defraud landlords. Camden has taken steps to detect and prevent these scams, which is improving their financial performance.
Wow, that's interesting. And a bit unsettling, to be honest. So Atlanta's dealing with some unique challenges, but overall trending in the right direction.
Exactly. Now let's talk about another popular market for investors. Phoenix, they earned a B with a stable outlook. They're seeing declines in supply, which is positive, but pricing power remains limited for now.
So maybe not the explosive growth some investors were hoping for, but still a decent market overall.
Right. Now, both Raleigh and Orlando also earned Bs, but with moderating outlooks. Supply is easing in both markets, but pricing power will likely remain muted for most of the year.
Makes sense. What about Southeast Florida? They were one of Camden's top performers in 2024, but are expected to moderate in 2025. Why the slowdown?
Well, they achieved above-average occupancy levels last year, which is difficult to sustain in the long run. Plus, they're facing some new supply coming online, which will likely limit their pricing power.
Okay, so still a good market, but maybe not the superstar it was in 2024. Now, Dallas received a B with a stable outlook. What's holding them back?
Well, Dallas is still working through a lot of the new supply that was delivered over the past year, even though it's one of the nation's top metros for job growth and migration.
So solid fundamentals, but still facing headwinds from the recent supply surge.
Exactly. And lastly, we have Charlotte also with a B and a moderating outlook. They're dealing with elevated levels of new supply, particularly in the Uptown and South End submarkets where Camden has a significant presence.
Okay, so we've covered all the A and B markets. Now let's address the elephant in the room, the C graders. It seems like Nashville and Austin are both facing some serious challenges.
They are. Both markets received the same grades as last year, Nashville with a C and Austin with a C. They both posted negative revenue growth in 2024 and are expected to repeat that performance in 2025.
Yikes, not exactly music to investors' ears.
Yeah.
What's the main culprit in those markets?
It's the same story we've seen for a while now. New supply. It's been a persistent problem in both Nashville and Austin, and it's not going away anytime soon. The rapid population growth and job creation in those markets have attracted a flood of new development, which is tilting the market in favor of renters.
So even though they're in the Sunbelt and have strong long-term growth potential, the near-term outlook is pretty bleak.
Yeah, it's a classic case of too much of a good thing. Even in booming markets, oversupply can create headwinds for landlords.
It seems like a cautionary tale for investors who might be tempted to blindly follow regional trends.
Exactly. Even within a strong region, there can be significant variations in market performance. It all comes back to that need for careful research and due diligence. CAMD's market grades provide a great starting point, but investors need to do their own homework and understand the nuances of each market.
Well, that's a great overview of Camden's market outlook.
Yeah.
When we come back in part 3, let's take a closer look at their financials and see how these market trends are expected to impact their bottom line. Welcome back to Talk Tickers. So far, we've covered, Camden's strategic shift toward newer properties, their bullish outlook on the Sunbelt, and that fascinating market grade system they use.
Right, we've explored the why behind their strategy. Now let's dig into the how, the financial mechanics that will drive their performance in 2025.
Yeah, perfect timing, because I'm wondering how all these strategic moves are expected to impact their bottom line. What kind of guidance did they give for the year?
Well, they're projecting core FFO, that's funds from operations, a key profitability metric for REITs to be in the range of $6.60 to $6.90 per share,
Okay.
with the midpoint of $6.75.
Interesting. That midpoint actually represents a slight decrease from their 2024 results. What's causing that dip?
It's primarily due to higher anticipated interest expense. They're planning to carry a larger average debt balance in 2025, which makes sense considering, their acquisition and disposition strategy.
You're right. They did say they plan to buy before they sell, which will temporarily increase their leverage.
Exactly. But it's important to remember that this is likely a short-term impact. Their long-term growth story still appears to be intact.
Okay, that's reassuring.
Yeah.
So what does their same-store performance look like for 2025?
They're projecting flat same-store net operating income
Okay.
with revenue growth of 1% and expense growth of 3%.
So steady but not spectacular growth from their existing portfolio.
Mm-hmm.
But what about the impact of their development pipeline in those planned acquisitions?
Yeah, those will definitely contribute to their growth. They're anticipating a significant boost from their development communities that are currently in lease up.
Okay.
They've also budgeted up to $675 million for new development starts this year.
That's a considerable investment. It seems like they're confident in the long-term demand for multifamily, especially in those Sunbelt markets.
Absolutely. And let's not forget their acquisition strategy. They've set a target of $750 million for acquisitions in 2025, with a focus on newer properties in those high-growth markets we discussed.
So it's a multifaceted approach to growth, optimizing their existing portfolio, investing in new developments, and strategically acquiring assets that align with their long-term vision.
Yeah, it really does seem like they've got all their bases covered. They're not just reacting to market conditions, they're actively shaping their future.
Well, this deep dive into Camden's earnings call has been incredibly insightful. We've covered their strategic shifts, their market outlook, their financial performance, and even generated a, not financial advice trade idea.
It's clear that Camden is a company that's not only adapting to a changing market, but proactively positioning itself for continued success.
Right, and they're doing it all while emphasizing a strong company culture and a focus on customer satisfaction. That's a combination that should serve them well in the years to come.
I completely agree. It'll be interesting to see how their strategy unfolds and whether their bullish outlook on the Sunbelt proves accurate.
Definitely.
Yeah.
This earnings call has given us a lot to think about, and hopefully our listeners have gained some valuable insights as well. Remember, this is just one perspective. It's always crucial to do your own research, consider your investment goals, and consult with a financial professional before making any decisions.
Absolutely. Until next time, keep learning, keep exploring, and happy investing.